Have you ever looked at the financial markets and felt like there must be like a shortcut? Or maybe not a shortcut, but a way to participate in big moves, gain leverage without putting all your capital on the line.
Yeah, that's a common feeling. People are always looking for that edge.
Well, today we're diving into something that often feels like that options. They seem complex, maybe even like a secret language to some, but they're incredibly powerful tools once you understand them. And the material you've shared provides a fantastic roadmap for this exploration.
Absolutely.
Our mission today, to really peel back the layers on options, not just, definitions, but how they actually work, why they've become so popular, especially in places like India, and crucially, what hidden forces make them tick.
Exactly.
We want you to walk away from this deep dive feeling genuinely well-informed.
That's the goal, to demystify these contracts. We'll break down the history, the mechanics, the underlying dynamics into hopefully clear, actionable insights. So by the end, you'll have this solid foundation, look at options with, let's say, a new clarity.
Okay, let's kick things off by tackling a common assumption. You see options exploding in popularity, particularly in India, right? It's easy to think there's some brand new fintech invention.
Right, tied to digital trading and all that.
Yeah, exactly. But that's, well, it's not really the case, is it?
Not at all. The history is actually quite deep and global. Custom over-the-counter options, OTC options on commodities, they first showed up way back in the 1920s.
Wow, the 20s?
Yeah, these were bespoke deals, between two parties. Then things got more formal. Equity options started trading on the CBOE, the Chicago Board Options Exchange, in 1972. That really standardized things.
Okay, so CBOE 72 was a big step for stocks.
Huge. Then you had currencies and bonds getting OTC options in the late 70s. Exchange-traded currency options started, I think it was the Philadelphia Stock Exchange in 82. And interest rate options on the CME in 85. So, yeah, these have been evolving internationally for decades.
It's fascinating how these innovations spread. So bringing it to India, your research mentions this BADLA system. What was that exactly? Sounds a bit mysterious.
Huh. Yeah, it does sound a bit old school. The BADLAT system, well, it was basically an informal kind of gray market arrangement. It predated the official derivative exchanges. Think of it like a rollover mechanism for speculative bets.
So not really regulated?
Not formally, no. It operated in a gray area and was phased out for the structured system we have now. Which brings us to the official launches in India. Index futures kicked off in June 2000.
Right.
Then index options in June 2001. Stock options followed quickly in July 2001, and single stock futures in November 2001.
Okay, so the instruments were technically there from 2001, but you mentioned something crucial. Real liquidity in Indian index options didn't really show up until 2006. What happened then? What flipped the switch?
That's a really important point because, I remember trading back then, and it was tough. Spreads were wide, getting fills wasn't easy.
So what changed around 2006?
Well, a major event, in my view, was the formal split between the Ambani brothers. The separate listing of their companies unlocked enormous value for shareholders.
Ah, okay. That makes sense. A huge corporate event drawing in more players.
Exactly. It triggered, I think, a real vibrancy, serious liquidity. Lots of institutional money started flowing in, professionalizing the whole segment. But, and this is important, Indian stock options. They still have a long way to go to catch up with international markets in terms of liquidity. Index options are king in India.
Got it. So that history is vital context. Now let's get down to brass tacks. What is an option, fundamentally? Your sources use this great analogy, the Ajay Venu land deal. Let's unpack that.
Okay, picture this. Ajay wants to buy Venu's land. Price is, say, Rs 500,000. But Ajay's heard rumors about a new highway project nearby. If that happens, the land value could soar. Venu, though, he just wants to sell now.
Okay, classic scenario. Uncertainty versus wanting a sure sale.
Right. So Ajay comes up with a clever plan. He tells Venu, look, I'll pay you Rs 100,000 right now. Non-refundable.
A significant upfront payment.
Yes. In return, Ajay says, you agree to sell me the land 6 months from now for the fixed price of Rs 500,000. And here's the crucial part, the kicker.
What's that?
Only Ajay can back out of the deal. Venu has to sell if Ajay wants to buy. If Ajay walks away, Venu just keeps the Rs 100,000.
Okay. So that Rs 100,000 fee, it does something very specific. It buys Ajay a right, the right to buy the land, but not the obligation. He can choose.
Precisely.
But for Venu, it creates an obligation. He must sell at that fixed price, Rs 500,000, 6 months later, but only if Ajay exercises his right. And Ajay has that critical ability to just say, no thanks.
You've got it. That's the core dynamic.
So walk us through the possibilities for Ajay after 6 months. What happens to his profit or loss?
Absolutely. Let's look at the three main scenarios for Ajay, who we'll call the options buyer here. Venu is the option seller. Scenario 1, price skyrockets. The highway is announced. Land value jumps to, let's say, Rs 1,000.
Wow. Big jump.
So what does Ajay do? He definitely exercises his right. He buys the land from Venu for the agreed Rs 500,000. His total cost, that's the Rs.
Yeah.
500,000 for the land plus the Rs, 100,000 fee he already paid. So Rs 600,000 total.
All right, 600K total outlay.
But the land is now worth Rs 1 million. So his profit is Rs 400,000. That's Rs 1 million minus his Rs 600,000 cost. And think about it, that's a 400% return on his initial Rs, 100,000 risk. Venu, meanwhile, he has to sell for 500K when it's worth $1 million, a big notional loss for him.
Okay, that's the upside scenario. What if the price goes down?
Scenario 2, price tanks. Highway rumor was just that, a rumor. Land price drops to Rs 300,000.
So Ajay wouldn't buy it then, right?
Absolutely not. Why pay Rs 500,000 for something worth only Rs 300,000? He just walks away. His loss is limited to the Rs 100,000 fee he paid up front. That's it.
And
Venu keeps the Rs 100,000 fee and still owns his land, now worth Rs 300,000.
Okay, final scenario. What if the price just stays the same?
Scenario 3, price is flat. 6 months later, the land is still worth Rs 500,000.
So does Ajay buy?
Still no. Think about his total cost again. It would be Rs 500,000 for the land plus the Rs 100,000 fee, so Rs 600,000. Why pay Rs 600,000 for land worth only Rs 500,000? Makes no sense.
Right. Still cheaper to just buy it on the open market if you really wanted it.
Exactly. So again, he walks away, loses his Rs, 100,000 fee, Venu pockets the fee.
That Ajay Venu example is brilliant. It really clarifies things. So let's translate that. What are the key takeaways for understanding options in the financial markets?
Okay, first, that upfront payment, the Rs 100,000 fee. In options language, that's the premium.
Premium.
Got it. Second, paying the premium gives Ajay, the options buyer, a right, in this case, the right to buy, but never an obligation. He always has the choice.
Right. Buyer's rights.
Third, Venu, the options seller, or sometimes called the writer, receives the premium. In return, he takes on an obligation he must sell if the buyer chooses. Seller has obligation.
Okay, rights versus obligations. Crucial distinction.
Fourth, the outcome hinges entirely on the price of the land. That land is the underlying asset. It could be a stock, an index, a currency.
The underlying. Makes sense.
And this whole setup, that's an options agreement. Ajay's side, the right to buy, is what we call a call option.
A call option. So like buying the right to buy, say, Infosys shares at a specific price. That fixed Rs 500,000 in the land deal. That's
the strike price, the predetermined price at which the transaction can occur.
Strike price. Okay, so what does this structure mean for the profit and loss? You mentioned Ajay's 400% return, but also Venus' potential loss.
Right. For a call option buyer like Ajay, the big draw is limited risk. The most you can lose is the premium you paid, but you have theoretically unlimited profit potential if the underlying price goes way up.
Limited risk, unlimited profit. Sounds great for the buyer. What about the seller, Venu?
It's the mirror image. The seller gets the premium upfront, that's their limited profit potential. But if the price skyrockets, their loss potential is theoretically unlimited because they have to deliver the asset at the lower strike price.
Okay, limited profit, unlimited risk for the seller. That explains why selling requires more caution, maybe more capital.
Absolutely. Now, that breaking point is key too. For a call option buyer, you only start making net profit once the underlying price goes above the strike price plus the premium you paid.
Right, you have to cover the cost of the option itself.
Exactly. Take Bajaj Auto. Say you buy a call option with a 2050 strike price, and you pay a premium of 6.35 per share. Your breaking point isn't 2050, it's 2050 plus 6.35, so 2050 6.35. The stock needs to rise above that for you to actually profit.
That break-even calculation is vital. Now, something fascinating came out of the Ajay Venu example. Venu, the seller, seemed to have better odds, right? He won in 2 out of the 3 scenarios.
That's right, 66.66% chance in that simple model.
Does this statistical edge explain why a lot of sophisticated traders, the smart money, often prefer to be option sellers rather than buyers? They're playing the probabilities.
That's a huge part of it, yes. They're often playing the odds, collecting premium, betting that the option will expire worthless or decline in value. Time decay, which we'll get to as theta, is constantly working in the seller's favor.
But they have to manage that unlimited risk somehow.
Absolutely. Managing that tail risk is paramount for sellers. They often use spreads, buying another option to cap potential losses or hedge with the underlying asset. It's not just about collecting premium, it's about risk management.
Okay, that covers call options, the right to buy. What about the other side of the coin? What if you think the price is going down?
Then you're looking at a put option. A put option buyer is bearish. They expect the underlying price to fall.
So a put option gives the buyer the right to sell.
Exactly. The buyer gets the right to sell the underlying asset at a pre-agreed strike price before the option expires. The put seller has the obligation to buy the asset at that strike price if the buyer exercises their right.
Same dynamic, buyer's right, seller's obligation but flipped for selling. And the risk reward.
Similar logic. The put buyer's risk is limited to the premium paid. Their profit potential is substantial if the price crashes, though technically capped because the stock price can't go below zero. The put seller collects the premium, limited profit, but faces large losses if the price falls significantly below the strike price.
And how do you calculate the intrinsic value for a put? It must be different from a call.
It is. For a put option, intrinsic value equals strike price minus the spot price. It only has intrinsic value if the strike is above the current market price.
Okay, calls and puts understood. Now, you often hear options described by their moneyness. In the money, at the money, out of the money. ITM, ATM, OTM. Can you break those down?
Sure. It all relates the option strike price to the current market price, the spot price of the underlying asset.
How so?
An ITM, or in the money option, is one that already has intrinsic value. For a call, that means the spot price is higher than the strike price. For a put, it means the spot price is lower than the strike price.
So it would be profitable to exercise immediately, ignoring the premium paid for a moment.
Correct. An OTM, or out-of-the-money option, has zero intrinsic value. For a call, the spot price is below the strike. For a put, the spot price is above the strike. Exercising it would make sense.
Makes sense. And ATM?
ATM, or at the money, is simply when the strike price is very close to, or essentially equal to, the current spot price. You also hear deep ITM or deep OTM for options far away from the current price.
And here's where it gets really interesting. ITM options are always more expensive than OTM options for the same expiry, right? Because of that intrinsic value component.
Always. That built-in value commands a higher premium. The rest of the premium above the intrinsic value is called time value, which reflects the chance the option could become more valuable before it expires.
And traders need a way to see all these different strikes and their prices easily. That's the option chain.
Exactly. The option chain is your central dashboard. It lists all the available strike prices for an underlying, usually vertically. It shows the premiums for both calls and puts at each strike, volume, open interest, and often highlights which ones are ITM, ATM, or OTM, sometimes with color coding. It's indispensable for traders.
All right, we've got the structure, the types, the moneyness. Now for the really dynamic part, what actually makes those premiums change second by second? This brings us to the option Greeks. I like the analogy from your source, like a Bollywood movie success isn't just one thing.
Right, it's a mix. Storyline, actors, direction, music.
Yeah. Option premiums are similar. They're driven by a mix of underlying factors, and we measure the sensitivity to these factors using the Greeks.
Precisely. And there are four main Greeks you absolutely need to understand: delta, gamma, vega, and theta.
Let's start with delta. What's delta telling us?
Delta measures how much the options premium is expected to change for every 1 point move in the underlying asset's price. It's basically measuring directional sensitivity.
Okay, sensitivity to direction. And it has specific ranges, doesn't it? Calls are 0 to 1.
Correct. A call option's delta is positive, between 0 and 1. A delta of 0.5 means the premium should move about half a point for every 1 point move in the underlying.
And puts?
Puts have a negative delta, between magical 1 and no. The negative sign just shows the inverse relationship. If the underlying price goes up by 1 point, a put option with a delta of narrow 0.5 would typically lose about half a point in value.
Can you give a quick practical example, say with Nifty?
Sure. Let's say Nifty moves up 100 points. An OTM call option might have a low delta, say 0.05. Its premium might only increase by about 5 points, 100.05. But an ATM call option might have a delta closer to 0.5. Its premium could increase by around 50 points, 100.5.
So delta helps you choose how much directional exposure you want. And those bounds, 0 to 1 for calls, negative 1 to 0 for puts, they make intuitive sense, right? An option can't lose more value than it has, and it generally won't move more than the underlying itself.
Exactly. The premium can't go below 0. and the option's price change is typically capped by the underlying's move, which leads us to something called delta acceleration.
Acceleration, what does that mean?
It describes how delta itself changes as the underlying price moves. A deep OTM option has a delta near zero. As the price moves towards the strike price, the delta starts increasing slowly at first, then faster as it approaches ATM, where delta is around 0.5 for calls, negative 0.5 for puts. Then, as it moves deep ITM, the delta approaches 1 for calls or minute 1 for puts, and the rate of change slows down again.
So the change in delta isn't linear.
Not at all. And that takeoff and acceleration phase, as an option moves from OTM towards ATM. That's where your sources say the maximum bang for the buck lies for option buyers.
Why is that?
Because the option is still relatively cheap, being OTM, but its responsiveness to price changes, delta, is increasing rapidly. This is how you get those sometimes bizarre stories of huge percentage gains. The 2009 Nifty election rally example in material OTM calls reportedly gained 1,300% overnight. That's delta acceleration in action.
Incredible. So timing that transition from OTM to ATM is key for those explosive moves. Now, I've also heard delta described as a rough proxy for probability.
Yes, that's a common interpretation, though not perfectly precise. The delta value, say 0.3 on a call, can be seen as roughly indicating a 30% probability that the option will expire in the money, ITM. A 0.1 delta suggests maybe a 10% chance. It's a useful heuristic.
And how does delta compare to, say, trading futures?
Good question. A futures contract essentially tracks the underlying point for point, so its delta is considered to be 1.
Always 1.
Yes. So if you wanted to replicate the directional exposure of one Nifty futures contract using options, you could, for instance, buy 2 ATM call options, since each would have a delta of roughly 0.5. 2 times 0.5 gives you a total delta of 1, matching the future.
Interesting way to think about equivalency. Okay, delta covered. What's the next Greek?
Next up is gamma. If delta is your option speed relative to the underlying, gamma is its acceleration.
Acceleration.
Yes. Gamma measures the rate of change of delta. It tells you how much the delta itself is expected to change for every 1-point move in the underlying. In calculus terms, delta is the first derivative of the premium with respect to price, and gamma is the second derivative.
Okay, so gamma dictates how quickly your directional exposure delta changes. And unlike delta, gamma is always positive for buyers, right? Whether it's a call or a put.
Always positive if you buy an option, long option position. Being long gamma means your delta works increasingly in your favor when the market moves your way and decreases your exposure when it moves against you. If you sell an option, short option position, you are short gamma.
And being short gamma, that sounds risky.
It can be very risky, especially if you're not prepared. When you're short gamma and the market makes a large move against your position, your delta exposure actually increases. The loss accelerates. That's why the advice is generally to avoid shorting options that have very large gamma, unless you really know what you're doing and have risk controls in place.
You need to be aware of that acceleration against you. When is gamma typically largest?
Gamma peaks for ATM options, and it gets significantly larger as the option gets closer to its expiry date.
So ATM options near expiry are the most sensitive to having their delta change rapidly.
Exactly. That's where the delta can swing most dramatically with small price moves.
Got it. Delta is speed, gamma is acceleration. What's next?
Next is theta. Theta is all about time. Options are often called depreciating assets because, all else being equal, they lose value simply as time passes. That erosion of value due to time is theta.
Time decay. And this relates back to the premium components we discussed.
Precisely. Remember, premium intrinsic value plus time value. An OTM option has 0 intrinsic value, so its entire premium is time value. An ITM option has both. Theta represents the rate at which the time value portion of the premium decays.
How is theta usually expressed?
It's typically shown as a negative number, representing the amount of points the option premium is expected to lose per day due to time decay alone.
Negative for the buyer, then.
Yes. Theta is the option buyer's enemy, constantly working against them. But for the option seller, theta is their friend. They profit from this daily decay, assuming the underlying price doesn't move adversely. That statistical edge we talked about earlier, theta is a big driver of it.
And does this decay happen evenly over the option's life?
No, not at all. The rate of time decay accelerates as the option gets closer to expiry. If you look at a graph of time value versus time to expiry, it's not a straight line down. It's a curve that gets much steeper in the final weeks and especially the final days. The value melts away much faster at the end.
So holding options, especially OTM ones, into the last few days can be brutal if the expected move doesn't happen.
Very brutal. Theta decay becomes relentless.
Okay, delta, gamma, theta. One more main Greek.
The last of the big four is Vega. Vega is all about volatility.
Volatility, we hear that word a lot. How should we think about it simply?
In simple terms, volatility is a measure of how much an asset's price is expected to fluctuate or jump around. It's the riskiness or dispersion of returns. Statistically, it's often measured by standard deviation.
Like the cricket analogy in The Source, Billy and Mike.
Exactly. Billy was consistent, maybe scored 30, 40 runs every match, low volatility. Mike was unpredictable, sometimes out for zero, sometimes hit a century-high volatility. Same average maybe, but very different risk profiles.
And there are different types of volatility we need to know.
Yes. There's historical volatility, which is calculated based on how much the price has moved in the past. There's forecasted volatility, which is what analysts predict it will do. But the most important one for options pricing is implied volatility, or FREE.
Implied volatility, what's that?
FREE isn't calculated from past prices. It's the level of volatility that is implied by the current market price of the option premium itself. It represents the market's collective expectation, its consensus forecast of how volatile the underlying will be between now and the option's expiry.
So 4 is forward-looking, baked into the option price.
Exactly. And in India, the official measure of implied volatility for Nifty options is the India VIX. You often hear it called the fear index.
Why the fear index?
Because it tends to spike higher when market participants expect large swings or uncertainty, often associated with fear or potential downside risk. When the VIX is high, options generally become more expensive.
Okay, so that brings us back to Vega. What does Vega measure?
Vega measures how much an options premium is expected to change for every 1% change in implied volatility FAR.
And is it positive or negative?
Vega is always positive for both calls and puts if you're long the option. Higher implied volatility means a greater chance of large price swings, which increases the potential value of any option, call, or put. So higher 4V generally means higher premiums, and Vega quantifies that sensitivity.
Does time to expiry affect Vega?
Yes, significantly. The impact of a change in volatility Vega is much greater for longer-dated options. Options with more time left have more potential to benefit from increased future volatility. Vega shrinks as expiry approaches.
Now, your source had this absolutely fascinating real-world example about Vega from August 24th, 2015. This is where things get counterintuitive.
Ah, yes, that was a wild day.
Nifty crashed almost 6%, a huge drop. Normally, you'd expect call options, especially out-of-the-money calls, to get crushed.
Absolutely. The underlying price tanked, which is bad for calls. Their delta is positive.
But what actually happened to some OTM call premiums on that day?
Amazingly, some OTM call premiums shot up by 50%, even 80%.
How is that even possible? The market crashed.
It's a perfect example of the Greeks interacting, sometimes in unexpected ways. What happened was a cross-interaction. Yes, the falling Nifty hurt the calls via their delta, though OTM options have low delta, limiting the damage. But the implied volatility, the India VIX, exploded that day. It surged something like 64% due to the market panic. And OTM options, while low delta, can still have significant Vega. That massive spike in VIBE acting through Vega overwhelmed the negative impact from delta and actually drove the premiums higher.
Wow. So the fear factor, the volatility spike, was so strong it made even bullish bets, calls, increase in price during a crash. That really shows you can't just look at direction.
You absolutely can't. You have to consider volatility, time decay, the whole picture. The Greeks tell that story.
Okay, we've covered the core concepts, the Greeks. Now let's bridge this theory to practice. How can traders strategically use this understanding, particularly around volatility and probability?
Great question. There are several practical applications. First, range prediction. Using historical data, like Nifty's average daily return and its standard deviation, a measure of volatility, you could estimate a probable trading range for a future period.
How does that work?
Well, basic statistics tells us price movements tend to fall within certain bounds, assuming a normal distribution, which is a simplification but useful. For example, you can calculate the expected range for, say, the next 30 days, where prices might stay within one standard deviation about 68% of the time, or within two standard deviations about 95% of the time.
So it gives you a statistical target zone for where the market might trade.
Exactly, which leads directly to an option writing strategy. If you can estimate that range, you can look at selling options outside that range, OTM options, that are statistically unlikely to be reached by expiry.
Like selling calls above the upper end of the predicted range or puts below the lower end?
Precisely. You're aiming to collect a premium, betting that the underlying will stay within its statistically probable bounds and the options will expire worthless. For instance, selling options maybe 1.5 or 2 standard deviations away.
How do you decide which strikes exactly? Is it just the math?
It's probability combined with risk assessment. The normal distribution gives you the odds. Selling a call 2 standard deviations away might have, say, only a 2.5% chance of ending up ITM. That's attractive statistically. But you also have to consider the risk. Markets can have fat tails and extreme moves happen more often than the normal distribution suggests.
Right, the black swan events.
Exactly. And generally, panic spreads faster than greed. Market crashes tend to be quicker and sharper than rallies. So many traders feel slightly more comfortable shorting OTM calls than OTM puts, as the risk of a sudden extreme upward move might feel lower than a sudden crash. But both carry significant risk.
Okay, that makes sense. What about using volatility for stop losses?
Yes, a volatility-based stop loss. Instead of a fixed percentage stop, like always using 5%, which ignores the asset's normal behavior, you can use its recent historical volatility.
How?
You could, for example, calculate the average daily price range or standard deviation over the last, say, 5 or 10 days. Then set your stop loss at a multiple of that volatility below your entry for a long position, or above for short. The idea is to place the stop outside the expected daily noise specific to that stock, reducing the chance of getting starved out by random fluctuations.
That sounds much more adaptive than a fixed percentage. Now, flipping to the buying side. Any rules of thumb based on timing within the options series?
Yes. Generally, if you're early in the options series, say, the first half, and you expect a quick, sharp, significant move, buying cheaper, far OTM options might make sense. You're hoping for that delta acceleration to kick in and give you explosive gains. It's a lower probability, higher reward play.
But if it's later in the series?
If you're closer to expiry, or you expect a slower, steadier move, then buying ATM or slightly ITM options is often more prudent. Their delta is higher, giving you better participation from the start, and they suffer less from the accelerating time decay, theta, compared to far OTM options. The time value on those far OTMs just melts away too quickly near the end.
Okay, let's make this even more concrete with some of the real-world trade examples from the source material.
Sure. First, there was a CEAT India trade. This was described as an options newbie making a directional bet buying a naked put option, expecting the stock to fall after a rally.
And it worked?
Yes. The stock reversed, and the put premium appreciated quickly, giving a nice profit. It highlights the potential of simple directional bets. But the source also noted nuances. Maybe selling a call spread would have been better if the view was more sideways, especially considering liquidity in stock options can be tricky. But as a pure directional play, it worked.
Okay, what else?
Then there was an RBI news play on Nifty options. This involved a short straddle.
Selling both a call and a put at the same strike.
Exactly. Selling the ATM call and the ATM put simultaneously, right before a major RBI policy announcement. The trader wasn't betting on direction. They were betting that the high implied volatility before the event would collapse after the news was out, regardless of the outcome.
Ah, a volatility crush play.
Precisely. 4 often spikes due to uncertainty before big events. Once the news hits, uncertainty resolves, IV drops, and the seller profits from that drop in premium, hoping the market doesn't move too violently in either direction. This trade captured that effect. It highlights why selling options before known events is often preferred by pros over buying them.
Interesting. Selling the uncertainty premium.
Then a very similar strategy for Infosys Q2 results. Another short straddle, but executed perhaps even better, selling the ATM options 4 days before the results. Again, the goal was profit from volatility compression as the event passed. It shows consistency in applying that principle.
Well, okay, selling volatility. Any buying examples based on fundamentals?
Yes, the last one was Infosys Q2 Aftermath. This was different. It was a fundamentals-based naked call buy. After the Q2 results, Infosys stock fell about 6%, mainly due to guidance concerns, even though the results themselves were decent.
So the trader thought the market overreacted.
Exactly. Believing the drop was excessive based on the fundamentals, the trader bought a slightly OTM call option, betting on a bounce back. It wasn't just technicals. It was driven by a view on a company's value versus the market reaction. It shows how you can combine options with fundamental analysis.
That's a great set of examples showing different approaches. Directional, volatility selling, fundamental overlay. Wow, what an exploration. We've really gone from the hidden history of options, that simple land deal idea, all the way through to the intricate dance of the Greeks and seeing how these strategies play out, this deep dive hopefully gives you a much clearer lens, maybe even a new vision to look at options more professionally, perhaps.
I hope so. And if we tie it all together, think about what many sophisticated option traders are often doing. They might not just be making big directional bets. A lot of the game is about capturing those small variations in premiums, profiting from time decay, theta, or volatility changes, vega.
The premium harvesting idea.
Exactly. So the provocative thought I'd leave you with is this. What would it really take? What systems or discipline to consistently profit from those dynamic premium variations day in, day out? And how does that constant effort balance against the ever-present risk that Nassim Nicholas Taleb described so vividly for option sellers?
The black swan risk.
Right. The risk of eating like a chicken, collecting small premiums consistently, but then occasionally shedding like an elephant, experiencing a rare but catastrophic loss that wipes out many previous gains. How do you balance that statistical edge with that potential tail risk?
That's definitely something to mull over, especially thinking about long-term consistency versus short-term gains. A perfect place to pause. We really hope this exploration provides a solid foundation and maybe sparks your curiosity to continue your own deep dive armed with this deeper understanding.